Now we will take a moment to introduce you to our speakers. Our speakers today are Conrad Schweitzer, Paula Bedford, Perry DeFranco, and Corinne Conley. Conrad is a principal in Raymond's Public Sector Assurance and Financial Reporting Group. He provides financial statement audits and compliance services, with a focus on serving a diverse range of not-for-profit organizations. Paula is also a principal in the firm's public sector assurance practice, with a focus on not-for-profit organizations. She most often manages and serves as a reviewer on audit and single audit engagements. Harry is a manager on Raymond's advisory and tax services team. His focus in the public sector is on providing tax services to not-for-profit entities. Corinne is a principal on Raymond's Human Resource Solutions team. She is people-focused, providing leadership, management, and strategic input on broad HR initiatives, which cultivate positive and results-driven work cultures. Conrad, you may begin the presentation.
Great. Thank you, Darren, for that introduction, and good morning, everyone. Whether it's your first time joining us or are already familiar with this annual webinar series, welcome. We are thrilled you're here with us. We have a packed schedule. We'll review a newly effective accounting standard update, a couple refreshers, followed by uniform guidance and tax updates, and finally a discussion on the new Earned Sick Time Act. But we'll begin with a polling question and give everyone a minute to respond. Great. Our first topic is an accounting pronouncement that is effective now for calendar year-end entities, Accounting Standards Update 2023-08, Accounting for and Disclosure of Crypto Assets. This ASU adds a new subtopic under ASC 350, which is the existing guidance for intangible assets. The changes from this ASU are based on stakeholder feedback and provides accounting rules that are more realistic to capture the nature of crypto assets, which are currently treated as indefinite-lived intangible assets. That treatment was not considered to be beneficial for the users of the financial statements. Many nonprofits either stayed away from accepting crypto donations or anything related to it, or have dealt with the accompanying challenges. So this update provides for more specific guidance for these assets. Next slide, please. As mentioned, current guidance does not distinguish crypto assets and other intangible assets, which follow what is known as the impairment model, where we record the purchase of the asset at cost, and subsequently we're not truing it up or down for fair value. Instead, we have to assess for impairment. This means we only account for decreases in fair value and do not get to capture any increases. As a result, organizations can be stuck with a decreased value on an asset that may have since recovered its value. So really, we weren't showing the true economics of these assets, nor an accurate financial picture of the entity which holds them. So this new guidance shifts away from the impairment model to the fair value model. And we get to apply an old and familiar standard, ASC 820, for measuring fair value. We initially record the asset at fair value and remeasure it at fair value. There can still be some complexity since with the methodology of ASC 820, we still have to determine certain things such as the principal market in which the asset is traded. Another consideration with this model is that these assets would now become subject to whatever volatility occurs with the crypto asset. ASU 2023-08 is effective for fiscal years beginning after December 15th, 2024. So if you're a calendar year end, it's effective now. Next slide, please. So what specifically is a crypto asset? These assets are defined as follows. It needs to meet the definition of an intangible asset, which is to say it lacks physical substance. They should be secured with cryptography and be blockchain based, be fungible, not created by the reporting entity or its related parties, and additionally cannot provide any enforceable rights on underlying goods or services. Many of the more well-known cryptos would fall under this definition, Bitcoin and Ethereum, for example. It does get a little trickier with some other types, such as stablecoins or wrapped tokens. Those may or may not meet this definition. So it would require a close look, and we do recommend discussing it with an advisor. NFTs or non-fungible tokens, for example, would not meet this definition. And if the definition is not met, you would proceed with the currently existing impairment model. So as you can see, this standard really gets at updating the sometimes seemingly archaic guidance for more modern times. Next slide, please. Now that we've covered the accounting side of it, let's go through how crypto assets actually would show up in financial statements. For nonprofit organizations, your statement of financial position would show these assets separately from other intangible assets. The annual changes in fair value should also be presented separately in the statement of activities. On the cash flow side of things, if the crypto assets were received in the ordinary course of business, which includes contributions, and are quickly liquidated, then that activity would be presented as an operating cash flow activity. If the asset is donor restricted to long-term purposes, it would be presented as a financing cash flow. So overall, relatively simple requirements here on the presentation. Next slide, please. We, of course, also have new disclosure requirements for crypto assets. We would need to show certain details for each significant crypto asset holding. Unfortunately, though, the term significant is not defined in this ASU, so the organization would have to apply some judgment for what it would be considered the appropriate threshold for this. Required disclosure includes the name of the crypto, the cost basis, the fair value, and the number of units. For non-significant holdings, this same information would be provided, but in the aggregate. Additionally, we would need to have a roll forward in the aggregate of beginning and ending balances where we show the amounts for additions, dispositions, gains, and losses. Further, we need to describe the activities that resulted in the additions and dispositions. And lastly, disclose the methods that we used for determining the cost basis. One thing to note is if the crypto asset was received as non-cash consideration in the ordinary course of business, which again includes contributions and is quickly liquidated, certain disclosure requirements here would fall away. So there's some relief granted there. So that wraps up our discussion on ASU 2023-08 on crypto assets. Next slide, please. Moving on, we wanted to touch on a few concepts related to revenue recognition, just based on what we're seeing out there across organizations. None of these are anything new, but we see nonprofits sometimes have challenges in these areas since it can be pretty complex. So we just wanted to bring it back top of mind. Next slide, please. Specifically, the treatment of conditional and unconditional contributions. If a contribution was determined to be conditional, the result of that determination is that no revenue is recognized. Any cash that may have been received would be treated as a liability, commonly called a refundable advance. The contribution would remain conditional until the underlying barrier or the right of return or release has been overcome. Recall that conditional means the presence of both a barrier and a right of return or release. It is important to track conditional contributions, even if they don't get recorded as revenue, as there are certain disclosure requirements related to them. Unconditional contributions is when revenue recognition occurs. The timing of cash here is not a factor. And once it does become unconditional, the next step would be to determine the classification of that revenue based on the presence of donor-imposed restrictions. So really an important distinguishment here as it drives the entire revenue recognition process. Next slide, please. One area of complication for this, though, is when there's ambiguity in the documentation from the grantor or donor. Most commonly, donor letters and grant agreements, they're not written by accountants. So we see many instances of ambiguity or unclear language. Luckily, the standards address this directly, stating that if something is not clearly unconditional, it should be treated as conditional. So one remedy that organizations can have here is seeking clarification or revised language from the donor that would clearly make something unconditional. But in effect, what this tells us is that organizations need to support the conclusion that something is unconditional. Otherwise, the default assumption is that it is conditional. Next slide, please. One additional pain point we see in practice is differentiating a barrier from a restriction. Recall a barrier is part of the conditional, unconditional evaluation, which determines when we can recognize revenue, as these are things that a nonprofit needs to overcome to be entitled to those resources. A restriction relates to the type of revenue that is recorded, which means it's related to the step after we've already overcome the condition. And a restriction simply is a stipulation that is more specific than the broad limits of the nonprofit and the purpose for which it was established. So a common example is a donor stipulates that the contribution is for one specific program that the nonprofit operates. So that stipulation is more specific than the broad nature of the nonprofit and would be a donor-imposed restriction. The donor-imposed restriction does not prevent the nonprofit from being entitled to those resources. As a final note, we recommend organizations develop a process for clearly documenting whether a contribution that comes in is conditional, and if so, what made it conditional. That'll go a long way in ensuring the success and proper revenue recognition. Before I turn things over to Paula, we have a second polling question.
All right. Thank you so much, Conrad. Next slide. All right. Thank you, Perry. All right. So current expected credit losses, or CECL, as it is known. This is not new for this year. It was effective for all fiscal years beginning December 15th, 2022. So all of the 12/31/23 year ends and forward would have implemented the standard. So that means for all organizations, this is heading into year 2 for this. This is also just a reminder, this was not just applicable for nonprofit organizations, but all non-governmental entities. Next slide. So the purpose of this standard was to provide financial statement users with more timely reporting and disclosures of credit losses on financial instruments that are not reported at fair value. This was a shift from the incurred loss methodology, such as a loss is recognized only after a loss event has occurred or was probable. So it is now shifting to a model of where anticipated credit losses are determined over the contractual life of the financial asset by taking into consideration not only historical results, but also current conditions and a reasonable forecast. So in short, consideration now must be given on past, present, and future events. And also, more importantly, to remember, good documentation and calculations of your analysis is required to validate the amounts that you are reporting in your financial statements. We thought it was good to show a reminder of what is in scope and what is out of scope for this standard. So for some of the common in scope items that we ran across over the past year are your trade receivables, so known as your exchange transaction receivables, so your 606 revenues, as one would call them, and your loan receivables. The loan receivables tended to be a harder calculation to determine and had some significant changes that were needed when this new standard came out. And I'll go into that a little deeper on the next slide of just kind of what that effect had. For some of the out-of-scope items, the common ones that we came across are your investments at fair value, contributions and promises to give. So those are another big thing with the nonprofits. So those are not in scope for CECL, so you didn't have to worry about doing that standard for those nonprofits that had your significant revenue was your contributions and promises to give. And then also any common control loans and receivables, so related entity type loans and receivables, those were out of scope as well. All right. Programmatic investments. So many nonprofits do provide loans that meet the definition of programmatic investment. These are investments that are to further the tax-exempt objectives of the organization rather than to generate income. So due to the new standard, nonprofits needed to track and analyze these loans more thoroughly than before. So now you need to consider, who is your borrower? Who are you giving the money to? What do they do? How are they performing financially? What does their budget look like for the next year? What are their plans for the future? Now, essentially, you're developing a risk assessment by your customer or your borrower to determine what this credit loss for them would be. Just helps further that analysis. And then again, maintaining comprehensive records for your determination for the credit loss calculation. Another consideration that needed to be given in regards to these loans were loans that had forgiveness terms. So as we know, nonprofits do sometimes give loans of which are considered a promise to give. So a forgivable loan, and sometimes there is a payment portion expected. So CECL only impacts the portion of which the loan is expected to receive payment. So you need to bifurcate between those two portions of the loan if that in fact is part of the situation that you run across there. All right, proposed changes to uniform guidance. While this may not affect all nonprofits, especially if you don't have a significant amount of federal grant funding, but it is worth discussing and making sure all organizations know about these changes that are coming into play, especially with all the new and significant grant funding that is out there and that we have been seeing coming through to the organizations over the past couple of years. These are some pretty significant changes that we all should probably know about. All right, so the main proposed changes for this year, which are effective for October 1st, 2024. So the big one, increasing the threshold from $750,000 to $1 million. This also increases the type A threshold for your programs as well. This is a very welcome change for a lot of organizations, especially there were some that just went above that 750 threshold in the past year and are having their single audits for the very first time. This now eliminates that for several organizations. Also, for audits covering multiple recipients, it expands what must be reported on the CFA. So a little bit extra work there. And then the other big change, it reduces the de minimis indirect cost rate, or it raises it from 10 to 15%. So again, a welcome change for many organizations that do use the de minimis rate. All right, and then your audit implementations. So the new uniform guidance requirements will be implemented for audits with fiscal years ending as of September 30, 2025 and after. So this is kind of one of the first changes that have a September 30 as your first implementation date. We usually see those as December or even June. So September 30th, 2025 is when the audit implications will take place for this change, the uniform guidance. And then some of the other changes that came into play with this was they did raise the equipment and unused supplies threshold from 5,000 to 10,000. It modified and expanded definitions for period of performance and question costs. Modified the definition of modified total direct cost to exclude subawards above $50,000, and then removes the prior written approval for certain sub awards. We all love to see changes that are cutting back or streamlining procedures and processes. And this is exactly what a lot of these changes are doing within this uniform guidance. However, remember to always refer to the formal guidance in detail in regards to what is actually changing, how that affects your organization, and feel free to reach out to your auditor with any questions that you have about any of these potential changes that are coming through. All right. I believe we might have another polling question before we move on.
Actually, I think the next one will be in just a few slides.
All right. Thank you.
All right. Thank you, Paula and Conrad. Hi, everyone. I'm Perry. I was introduced at the beginning here, so I'm going to do a little bit of a tax update. Here's just an outline of what I'm going to cover. I'd say the first 3 points there, I would consider those more of updates, whereas the latter 2 at the end are more so refreshers or just reminders on areas we want you to pay attention to. Our first slide here, we're focusing on the priority guidance plan, which was for July 1st, 2024 through June of 2025. So that's still ongoing. This includes 231 projects aimed at allocating Treasury Department and IRS resources. Recommendations for this yearly plan are solicited from taxpayers, tax practitioners, and industry groups. Listed on the slide, we show the current 10 projects affecting exempt organizations, 9 of which are carried over from the prior year. That's something to keep in mind. A lot of these projects are carried over year to year for a few years until they're considered finished or no longer applicable. The bolded project is the new addition. This focuses on regulations for tax-exempt hospitals. Notably, 4 of the 10 projects relate to donor-advised funds. So this really highlights that they're focusing on donor-advised funds. And then the 7 areas covered by the plan this year are group exemptions, tax-exempt hospitals, UBI, which is unrelated business income, qualified tuition programs, self-dealing, again, donor-advised funds, and churches. So this is something I just recommend that you review annually, see what they're considering, and always check with your advisor if you have questions. All right, next we are moving into the TCJA sunset. So the Tax Cuts and Jobs Act of 2017 will sunset at the end of 2025. This means that many of its provisions will revert to the pre-2018 levels unless Congress acts to extend them. While highly unlikely, let's consider how this could affect charitable giving. I think that's what's most important here. So if these all revert to those pre-2018 levels, tax rates could increase. The standard deduction for individual taxpayers would most likely decrease, and the limitation on the state and local tax deduction would go away or change in a way that would affect individual taxpayers again. So all 3 of these, if they did revert to those pre-2018 levels, would increase the value of charitable contributions for those who itemize their deductions on the individual tax returns. So the higher tax rates would make the value of a charitable contribution go up. A lower standard deduction would increase the amount of taxpayers who itemize, as would a removal of the SALT cap. So those would all be beneficial things. Now, that's best case scenario for charitable giving, but let's consider what will most likely happen. It's a little too early to tell, but there has been some small movement. Hearings are already happening. The House Ways and Means Committee recently discussed the need to make the TCJA tax cuts permanent. If there are additional tax cuts, a decrease in charitable giving could occur. The same could be said if the standard deduction continues to increase for a married filing jointly couple that is getting close to about $30,000 for the standard deduction. So it makes that much more common choice than itemizing deductions. On the other hand, there have been talks of increasing the SALT deduction, so that's the state and local tax deduction. This would positively impact charitable giving as it would increase the number of taxpayers who itemize their deductions. Now, as I said, it may be too early to tell, but these topics will most likely be discussed further during 2025. So this is something we want to pay attention to as the year goes on. I also want to briefly mention the Charitable Act. Various organizations are advocating and lobbying for this above the line charitable deduction. It would include a deduction limited to 1/3 of the standard deduction. We think back to the pandemic where there was a small above the line charitable deduction for non-itemizers. It would be similar to this, but larger. Now, this was first introduced in 2023, and it's slowly been gaining support. So it's definitely not a sure thing. It's still gaining support, but it is notable because in the future, if this does get included in law, it could greatly change things for charitable organizations and the charitable giving they may see. All right, let's look at some clean energy tax incentives. The Inflation Reduction Act of 2022 extended and enhanced energy incentives for a wide range of green technologies. Now, historically, these incentives have been limited to for-profit businesses, but the Inflation Reduction Act, which I'm going to refer to as IRA, allows for both tax-exempt and governmental entities to participate, which is huge. The IRA includes a wide variety of clean energy technologies and projects. There are a few included on the slide here, things like solar panels, geothermal, alternative energy vehicles, and charging stations. So there's a bigger list, but this is just a few of them. All right, the credit and incentive amounts are determined based on either the amount of clean energy produced, the amount of qualified investment made, or the square footage of the building. Different rates and percentages apply, and bonus amounts are available based on facts and circumstances of each project. There are two ways for you to participate. Those are direct pay and a deduction allocation. Under the direct pay, also known as elective pay, tax-exempt entities would utilize Form 990T to report the credit and receive a cash refund. It is important to note that you do not need to already be filing a Form 990T to receive this benefit. And then the energy efficient building property deduction is generally available for energy efficient lighting, HVAC, hot water systems, and components of a building envelope. Generally, a tax-exempt entity would not benefit from a deduction like this. So this allocation of the deduction allows you to pass it on to the designer. So if you pass that on to the designer, you can use this deduction, they can use this deduction to offset their taxable income, since as a tax-exempt entity, you may not have any, which would allow you to negotiate a better contract price in consideration for transferring that deduction. So that's how you could utilize that. Changes for 2025, want to look at a couple of those. So starting January 1st of this year, the investment tax credit and the production tax credit were replaced by the clean electricity production tax credit and clean electricity investment tax credit. So they somewhat just extended the names there, but they're going to be fairly similar. The new credits are designed to be tech neutral and flexible between different clean electricity technologies, focusing on emissions reductions. Additionally, they both offer further incentives for projects that meet domestic content requirements or are located in energy communities. So we wanted to discuss this because this really is a rare opportunity for tax-exempt and governmental entities for them to be able to participate in credits and incentives normally reserved for for-profit businesses. So while these are currently in the code, their longevity may be influenced by the current political changes. We're not sure. But here at Raymond, we have a dedicated team focusing on these and would be happy to work with you on any projects you might see in your future. All right, we have our next poll question. So this is directly related to the clean energy tax incentives that we just went over. So it's whether or not you've heard of them. Just let us know. We'd love to push more information or talk with you directly about these. Okay. Make sure you're getting those poll questions answered. We're going to move forward. Now, I was thinking about this next slide a little bit last night, and I want to change my talking points a little bit, but just to go over the general parts of it here. Most tax-exempt organizations don't pay income tax uh, unless they file a Form 990T. So penalties are a way for the IRS to ensure compliance and generate funds from organizations that fail to meet these filing requirements. So a Form 990, a Form 990T, these both have May 15th due dates for calendar year entities. And if these forms don't get extended, or if they're filed after the original due date or the extended due date, that's where you'll see penalties come into play. And these penalties are adjusted for inflation each year. So the current slide, this slide right here, shows the penalties for returns filed in 2025. Now, I was considering this last night, and the IRS released RevProc 2024-40, which goes over much more things that were changed and shown increases for inflation purposes. So if you want to look at more of those, again, that's RevProc 2024-40. What I'm showing on the slide here is for returns that are most likely filed in the year 2025. So this would be a lot of our 2024 tax year returns, but they're filed in 2025. What the IRS just released in that RevProc focuses more on returns filed in 2026. So they're giving that information well over a year early. But I just wanted to highlight that this is for returns filed in 2025. So I'm going to move on to the 1099s. If your organization utilizes independent contractors, you may have 1099 NEC filing requirements. These penalties are on a per return basis with extremely high maximums. So it's a minimum of $60 per return, but then as more time passes for these 1099s, that will quickly double, plus some it'll go to 130 per return, and then it can go at least 2 times higher than that, maybe 3 times higher than that as more time passes. So again, I want to emphasize that these are on a per return basis. And the due date is just a week away on January 31st. So if you have any independent contractors or any other reasons why you would be utilizing 1099s, 1099 NEC, make sure you're getting those filed by the due date. Depending on the situation, penalties can be significant and they can impact your organization's finances, which would directly reduce funds for charitable programs and services. Timely filing of returns will avoid any penalties and ensure that more funds are available for your organization's mission. So that's mainly what I wanted to focus on with penalties, because they are a way for the IRS to get additional money from exempt organizations who don't pay income tax. All right. Next, we're going to move into the topic of compensation. So this is where we're getting away from our more so updates and more of a refresher or areas we think are worthy of a little bit more of a deep dive. Let's start with reasonable compensation. Per the IRS, everybody loves IRS definitions, but reasonable compensation is the value that would be ordinarily paid for like services by like enterprises under like circumstances. So in the normal market, what would that position normally pay? Let's consider it that way. So reasonableness is determined by the facts and circumstances of each situation. And why is this important and how can it affect your organization? Well, it is important enough that the IRS includes some questions about it on the Form 990, specifically in Part 6, Section B of the Form 990. Certain key employees in exempt orgs may have the ability to set their pay or possibly affect how their pay is set, which can lead to unreasonable compensation levels. These get treated as excess benefit transactions under Section 4958. Should this occur, and this is why this is really important, the person, not the exempt organization. So again, the person benefiting from the transaction is liable for a 25% tax on the excess benefit. That person can also be liable for a 200% tax on the excess benefit should it not be corrected by a certain date. Additionally, organization managers who participate in an excess benefit transaction knowingly, willfully, and without reasonable cause are liable for a 10% tax on the excess benefit not to exceed $20,000 for all participating managers. And that's on each transaction. So it's obvious that the IRS takes this very seriously, and we should too. So to avoid these penalties, exempt orgs should have an independent body or committee that approves compensation arrangements. They should rely on comparability data, and they should document the decision-making process. These are ways in which to protect yourself and your organization. All right, so Section 4960. This is excess executive compensation here. This imposes a 21% tax on compensation exceeding 1 million of certain covered employees, and also on excess parachute payments. So just a few more definitions here. A covered employee is one of the 5 highest compensated employees for the taxable year. Additionally, once someone becomes a covered employee, they are always a covered employee. Excess parachute payment, that is any payment contingent on an employee's separation from the organization that exceeds a baseline of 3 times the employee's base amount. This baseline that I'm referring to is the average annual compensation over the previous 5 years. The important thing to keep in mind with excess parachute payments is that the employee does not need to be compensated over $1 million. Rather, they just have to be one of the top 5 highest compensated employees that year. This is a threshold that is adjusted for inflation each year. For 2024, it was $155,000. So these areas of reasonable compensation and excess executive compensation can get pretty confusing fairly quickly. So if you have any questions, please put those in the chat and we'll get back to you on them. And then briefly, let's talk about transparency. So transparency in compensation is essential for maintaining public trust and ensuring compliance with IRS regulations, some of which we just discussed. It helps demonstrate the organization is using its resources responsibly and that the compensation decisions are made fairly and reasonably. So compensation for various executives, board members, and certain other highly compensated individuals is disclosed on the Form 990. This specifically shows up on Part 7. And also, if additional thresholds are met, it will also show up on Schedule J. So nobody enjoys seeing their compensation listed on the Form 990. That is just the specific rules that we must follow. And considering this is a public document, the 990 is, anyone can find a copy of that online. So while, again, it's uncomfortable sometimes, part of the IRS's rules related to transparency makes us have to include those amounts on the return. So we just want to bring that up so you're aware of it. Okay, then we're going to move on to our last topic, which is unrelated business income, also known as UBI. I really think this deserves a yearly refresher every year because it is an area that people are sometimes unaware that they even have it, what it is. So let's go over some things related to UBI over the next few slides. So not every exempt organization will have UBI. but they all can have UBI. So in its simplest form, UBI is business income from an unrelated activity. We're going to break this down a little bit further in the next few slides. UBI is allowed. It's completely okay to have, as long as it's not a significant part of your organization's activities. As with many IRS terms, significant has no fixed definition. It's based on facts and circumstances of each situation. However, should your UBI activity become too significant, it can affect your tax-exempt status. So that's why we want to pay attention to these things. There are various types of income excluded from UBI, which we're going to cover, I believe, on the next slide. The tax rate is generally 21%. However, trusts can have a different tax rate. And then on the right side of the screen here, you can see different types of organizations that are subject to UBI rules. This is not an all-extensive list here. So if you want to learn more, especially if your organization is affected, I'd recommend reading IRS publication 598. Okay. Let's look at the three main criteria for UBI. We're going to start with the IRS definitions, expand upon those, and then I'll give you an example here or there. So if all three of these areas on the screen are met, that means you have UBI. So we just wanted to show it there in a little graphic, but let's go over all three. So trade or business. This generally includes any activity carried on for the production of income from selling goods or performing services. Think of this as similar to a for-profit business. So if it resembles a for-profit business and compete with for-profit businesses, it's trade or business. Unrelated to the exempt purpose, our goal is to determine that it is substantially related to the exempt purpose. So to do this, we examine the relationship between income generating activities and the accomplishment of the organization's exempt purpose. So to give you an example, a charitable organization providing educational opportunities to underprivileged children, they might run a tutoring program. This activity directly furthers the organization's educational mission and is substantially related to its exempt purpose because it addresses the educational needs of the children. I'm sure there's many for-profit tutoring companies out there, but because this is related to the exempt purpose of this organization, it's all right to do here, and it doesn't generate UBI. And then regularly carried on. Business activities are considered regularly carried on if they show frequency and continuity similar to comparable commercial activities of non-exempt organizations. So if a commercial business would typically conduct the activity regularly, the same standard applies to the tax-exempt orgs. There's something in the code about intermittent and sporadic activities, like an annual fundraiser. These are generally not considered regularly carried on. However, seasonal activities, such as selling Christmas trees each December, that can be considered regularly carried on if they are conducted in a manner similar to normal commercial operations. So Christmas trees are generally sold each year by for-profit organizations. So something seasonal like that would be considered UBI. So when you look at all three of these categories, we want to be able to challenge at least one of these to determine that an activity is not UBI. I think this is our last slide on UBI here. So up on the screen, we have a list of common UBI activities. It's not an all-encompassing list, but some of the more common activities that we may see. Again, you'll want to refer to the previous slide and consider those three areas to see if what you're doing should be considered UBI. Advertising is one that many organizations will not think about, but is always UBI. Additionally, the IRS has several modifications, exclusions, and exceptions to unrelated business income. Those are listed up there under the exclusions exceptions section of the slide. And then we have some activities that are specifically excluded from the definition of UBI. So let's go over those really quickly. So volunteer labor, any trade or business is excluded in which substantially all the work is performed for organizations without compensation. So some fundraising activities, such as a volunteer operated bake sale, that might meet this exception here. And substantially, in this case, we usually take to mean about 85% or more of the work is performed by unpaid volunteers. And then we have convenience of members. So any trade or business is excluded that is carried on by an organization described in Section 501c3 or by a governmental college or university that is primarily for the convenience of its members, its students, patients, officers, employees. And a typical example you see for this is something like a school cafeteria. And then we have selling donated merchandise. All right. A trade or business is excluded that consists of selling merchandise, substantially all of which the organization received as gifts or contributions. So think of something like a thrift shop here, operations of an exempt org that has a thrift shop would meet this exception. And they also included something about bingo up there. So not everybody has bingo, but if you do, there is a bingo exception, and the activity has to meet the IRS definition of bingo. It can't violate any state or local laws, and it must be played in a jurisdiction where bingo games are not regularly carried on by for-profit organizations. So if that's something you're ever considering, you'll just want to look into those three things. And then we're going to look into one last thing related to UBI, and that's the siloing rules. This was introduced years ago at this point, but it is something that we always want to bring up. By siloing, I mean that UBI activities are grouped together only if they are similar, and this is determined by two-digit NAICS codes. There are 20 of these codes. So what the siloing does to your UBI activities is that losses from one activity are not able to offset income from another activity. So for example, UBI activity under a code that might be related to advertising cannot offset income from an activity that might be debt financed rental income. So these have to have their own silos, which affects your ability also to deduct net operating losses. So if you have operating losses in one activity, it's not going to be able to offset income in future years for other activities. So the siloing rules keep exempt organizations from combining losses from separate activities, and it really did significantly change the reporting structure around UBI. Ultimately, UBI is a very complex area. Always include your advisors in conversations if you're considering anything new to your organization. You might hear about new projects from board members or other people in the community. And while they are all great ways to generate income for your exempt organization, you have to take into consideration whether or not these things might generate UBI and cause additional filing requirements and possible income tax payments will need to be made. So I believe that was my last slide. I think we have our last poll. Oh, our fourth poll. We'll have one more after this. So we're just looking for what are you looking for in future tax updates? Did you enjoy the legislative updates? Do you want more about tax incentives or additional insights on Form 990? It's always great to learn more about the form in which your organization files. So let us know what you're thinking. All right, thank you, everybody. Move it on.
All right, the next topic, Earned Sick Time Act. We'll refer to it as ESTA. It's just an easy way to refer to it. If you'll move to the next slide. So this original legislation is due to go into effect on February 21st. Anybody who saw the original come out probably had concerns like a number of our clients do, and it dealt with the actual implementation of it. And we'll talk a little bit about some of the changes that took place from the paid medical leave to this, the Earned Sick Time Act, and then we'll talk about the actual two bills that have been introduced kind of in response to the ESTA that is on the books right now. So if you could move to the next slide. This slide really talks about and takes from the beginning of the paid medical leave, indicates who was covered, how it was accrued, whether you could carry it over, or whether or not you had to pay those out in under paid medical leave. So most people in paid medical leave, if you were 50 employees or above, would have had to have taken into account those 40 hours of time for employees. How each employer did that is very different. Some actually have separate banks. Some of them actually included in PTO. Those that included in PTO, the implementation of ESTA becomes a little bit more difficult. So some of the changes were it increased the number of employees. It then adds into it independent contractors, part-time, seasonal, and variable hour employees. It reduces the threshold of earning it. So you used to earn it at after 35 hours. Now you're earning it after 30. So you earn it at a faster rate. They increase the number of hours. And then the ESTA has a complexity of whether or not you carry time over or not. It does allow you to carry it. It only requires you to allow for the 72 hours for full-time employees. So paid in that regard, but we'll get into that in a minute. The 72 hours, if you're a larger employer, would require you to pay those 72 hours. If you're a smaller employer, which is less than 10, 40 of those hours would be paid and 32 of those hours would not be. So those are just some differences of what we originally started with, now what we've progressed to, and we'll get into the next two pieces of legislation next. So if you would move to the next one. So again, this one really moves us back from all employees or an employer who has 50 or more and reduces that down to one employee. So this would include basically everybody, whether you're working at a fast food restaurant or you are a small nonprofit or government entity. There are some exclusions for federal employees, but not one we're going to talk about today. So the next slide, we'll talk about some of those changes a little bit more, and it goes into the carryover is one that has probably been the concerning one for everybody. What's that liability going to be? Will it stay on the books? Do you have to carry it over? How do you report it? Those are all big concerns that are under this original ESTA. You can actually limit the usage to those 72 hours, which is important. So even though you may carry over hours from a prior year, the employee is still limited to only using 72 in a year. So that leaves what happens with the other hours. And that was undefined. The uses for earned sick time expanded. So most often in the earned sick time, it was the paid sick leave was really followed the FMLA requirements. But in this case, it expands it to include the closure of businesses, domestic violence, really calls out mental health care for employees as well, and still follows similarly the FMLA descriptions. So if you could move one more slide ahead. I'm a slide behind, sorry. So this really talks about those closures and the usage of that earned sick time. The closure obviously probably comes from the pandemic. We wouldn't have prepared for that, would not have known. So that really addresses that. In the event that something like that would happen, it would be permissible to use this time. If you go to the next one, notification requirements. Under ESTA, it talks about how employees notify employers. Under ESTA, it creates a challenge because it really, if you are using PTO time, what it does is it requires you to use a similar approach with the ESTA. If you have to follow along the guidelines of what ESTA requires for noticing if you commingle them. So that becomes another challenge for employers of not having the freedom to indicate how they would earn and how they would use their PTO time if the ESTA time is actually commingled. If you go to the next one, this is challenging for employers who have required sick notices after, for someone who's been gone for 3 days. Now it requires they have to be gone for more than 3 days if you wish to require that. The caveat is if you do require it, you have to pay for any costs incurred for an employee to receive that. So any out-of-pocket costs that may have been required for them to actually go to the doctor rather than I'm just sick, those would be on the burden of the employer. You're going to get these slides, so I know in the spirit of time, I'm going to skip over a couple of them in a minute. So I want you to know you'll still have the information, but I know that we have a time frame in this regard. So the do's and don'ts is how you can, the reasonableness, right? Require documentation for absences less than 3 days. You can't do that anymore. You can't ask for some details with regards to the illness or details of the violence. It really limits what employers can actually find. And then really some of those timeframes on what they would classify as in a timely manner. I'm not going to get into the definition of this. Is if you go to the next slide. I'm sorry, I keep forgetting. Okay. I had just gone over this one, the do's and don'ts. We'll go to the next slide, and I'm only going to highlight one thing on the next slide, and that's the definition of family members. It does broaden it, so it does take into consideration maybe a non-traditional family, someone who's actually acting in the capacity of family that may not be a blood relative. So we move on to the next one. This is the questions I would be asking if I were looking at your policy today. If you think to how your PPO policy, does it satisfy the ESTA requirements? I would be thinking about these things. Do you accrue at a faster rate than ESTA? Do you have a policy that has a waiting period? Do you require advance notification for time off? And how that would be impacted by ESTA? Do you allow a rollover? Do you allow cash outs? All of those types of things will impact the actual implementation of ESTA to ensure that employees have the time in their bank when they need it. And what would you do? The other caveat is how are you going to address individuals who may need to use time in advance of having earned it? And there is a provision that says as long as you have it signed off by an employee prior to that, if they decided not to return, had used time that they hadn't earned, you would be able to take it from their last check, but that has to be done in advance. So some things to think about as you roll out or you're implementing your policies. We're going to move forward. We have to do the next polling question, which is number 5 for you. And it is really, what is your organization's current PPO policy? And will it satisfy the ESTA? So those questions I asked you before are ones to think about as you try to coordinate and make sure that that works. We're going to move on to a couple more. I know we have 2 minutes left, so I'm going to move past this. There is a record keeping requirement. Notice and record keeping, so employees have to know what you're doing. They have to know what the expectations are. If we go to the next item, other considerations are your collective bargaining units. Most of you may not have that. Some may. With regards to that, it does give a provision for this to be negotiated into the next contract negotiation. Has reporting requirements, and certainly has some items that says there's no payout at termination. So there are considerations that are in here that you would need to pay attention to. I'm going to move to the next one, which is says additional legislation, and I'm going to give you a quick update. There are two House bill and a Senate bill that have been introduced. These are important. The House Bill 4002 is actually in session. The House is in session today, and that is on their docket. So this information may very well change, but it lines up the two bills side by side. The House bill addresses a lot of the details that we've seen from our clients about how to implement it. What is the increment of time that you have to account for? And it I think addresses a majority of the items. Our anticipation is we're going to see something different than all of these. We have 3 different pieces of legislation out there, and as we've seen in the past, most often we get a blend of something that takes a hybrid of all of these things. So my advice to you would be to take a look at what your policies are now. If you know whether or not you comply with what will come out on February 21st, great. If you need help in that, we certainly can assist you. And pay attention to the next 2 pieces of legislation that are out there, and maybe we'll know more today about what the House does. And my next one, the next slide you'll get to take with you is just what should you be doing. And it is reviewing your policies, making sure that you're ready to roll those out come the 21st. So that is my fast because we're limited of time. So if anybody has questions, feel free to reach out to us. We'd be happy to answer them. There's a lot of information here. And for most people, it's a complex piece of legislation to implement.
This concludes today's program. Thank you for joining us. With respect to people's time, we will be reaching out directly to answer all the questions submitted. If you would like to learn more, please visit Raymond's website at www.raymond.com. You can also email us at publicsector@raymond.com. Thank you and have a great rest of the day.